Dinshaw Irani joins us, CIO with Helios India. Let's take our conversation forward. Dinshaw, good morning. Thank you for joining us. I can argue both ways, right? We can talk about the breadth of the market which has collapsed, or we can feel happy about Nifty, which is still above 17,000.
Sorry, Nikunj.
No, I'm saying we can argue both ways
Okay,
right now.
okay, sorry. Yeah, I was waiting for the question. So very good morning to you, Nikunj, and a very good morning to your viewers as well. So Nikunj, we've been fairly cautious on the market all along. I mean, we can always use the fig leaf that we always buy stocks with 5 to 10-year outlook and stuff like that. But the fact is that we know that the short term is not that exciting as it was supposed to be. And in fact, that thanks to our hedge fund, which we run, which is a global offshore hedge fund, which we is the India dedicated hedge fund, that tells us that it's better to conserve on the downside than be aggressive on the upside. If you can conserve on the downside, you can be kings on the upside. Yeah. So that shows to us that we need to, for us, a long term has to be a series of short terms put together. And the short term didn't look too good. In fact, I remember coming on a channel in Jan itself and telling the viewers that we are being cautious. And our caution stemmed from the US Fed, actually. I mean, they were about to undertake a interest rate hike cycle. They were looking at a tapering going forward and stuff. But things have only deteriorated as the year has panned out. So we remain, and then frankly, I mean, if you look at the year till now, it's only been outliers which are ruling the roost. I mean, so your curve, which is a normal bell curve, has come up with fat tails, and that is very scary, not only for policymakers, but also for investors who are bound to go wrong in this market. So we remain cautious for the next quarter at least. And frankly, I mean, look at what's happening in India too. I mean, rural markets are not doing too well. Demand has only been falling, called out in September itself, and it's only gone down. And this quarter itself, again, will not be looking that good vis-a-vis the March quarter, which was a vengeance buying quarter and so on. And obviously, you looking at the commodity prices, the way they're going to hit the margins of most stocks getting reported. So we're on the cautious side, to put it simply.
So if you're cautious, how are you translating that into a portfolio positioning? Sitting on cash, going short?
Okay. Unfortunately, in India, you can't do shorting the domestic offerings as such because the tax rate takes away a lot of the gains as such. So what we've done here is that we've tried to cut down the exposure itself. In fact, we cut it down to around 11% of cash, which is lying with us today. We sold off positions a bit, trimmed down various sectors and came down to around 11% of cash. And we keep the cash, and we also know if the market's correct, this 11% cash is not going to protect us to an extent. By the way, in the AIF, we are at 15% cash. So it's not going to protect us much. But the fact is that it'll at least give us the leeway to sit back and analyze and see whether we're on the right track in the market, look at opportunities that come by, look at some ideas that they come by, and that gives us that leeway to do that rather than anything else. But in the offshore fund, obviously, we shorted quite aggressively. We're down to around 45% odd on the net side as such. So that's where we are there.
Dinshaw, I'm curious to know, what is it that you shorted? What is it that you've sold off and not have in your portfolio anymore?
Okay. So morning to you, Asha. What we did in the domestic portfolio was we trimmed quite a bit on our IT exposure, which probably in December onwards, we've been trimming that. So that generated a bit of cash for us. And then we trimmed a few ideas off, which we felt were, in fact, sold off a few ideas which we felt were overpriced anyway. So high PE stocks is what we sold off. In the short part of the portfolio, which is our offshore fund, that's where we really enjoy doing this, because that's where you can actually short stocks. So quite a bit of sectors which are impacted by input price pressures and obviously the demand not picking up. We are short there in those sectors. Autos is one obvious one. Then consumer durables is another one. Paints is another one. So these are the few that we've shorted across the board there. So.
But you still have your long going on ITC, or is that just a very minuscule bottom-up idea that you're working with?
No, that's worked perfectly. In fact, we thought we were buying a very stodgy stock, but the fact was that the stock does phenomenally well. And in fact, if anything, I think the management is also talking the language now. I think we are looking at some kind of value unlocking as such going forward. So if that happens, that's looking a very exciting name. And the fact is it's cheap, right? It's one of the cheapest FMCG stocks still, despite this move of 20 odd percent or 15, 20% or whatever that it's given in the past few months or such. So we remain with that. It's an integral part of the portfolio. So I'll leave it there.
Now, Dinshaw, you're cautious. You think there are a lot of tailwinds. You think there are a lot of short-term tail events which will have an impact on the market in the short term. Then why sit on only 15% cash? Why not 50% cash?
Yeah, that's what I said, Nikunj, that the fact is that the point is that we can always say that we buy stocks with a 5-year view and stuff, but we not that way. We see our hedge book and we say that we are cautious in the market. So in a way, in the PMS, there's not much you can do because you're selling across portfolios, right? It's not one single portfolio that you're running. In fact, in the AIF, you have that leeway. But there again, we waited since we were on the final closure. We waited for the new money to come in and increase our cash exposure there. And that's why the cash there is much higher. Yeah, you're right in the sense that, as I said rightly, previously also that 10% is not going to insulate us much. But the fact is it gives us that comfort, rather 11%, 11.5%. It gives us that comfort to, analyze our position and see whether we need to be more aggressively selling or just sit back. And frankly, the market's not gone anywhere from the time we've sold. So we still have that feeling that, okay, let's wait it out. Let's see how it goes. If things are moving up, if we believe that things are getting overpriced, obviously we'll be selling along the way, and it's going to be a stock specific call from here on.
So what is the part of your 1-year horizon basket and what is part of your 3-year horizon basket?
So we have two separate categories within us, within our portfolio, which is one is called high confidence and reasonable return. Now that's your stodgy portfolio. That's where you have stocks which are where ITC will be residing, right? So that's obviously a portion which is fairly long-termish in nature. There we have around 67, 68% invested. And the rest would be where you're trying to find out those future winners, which will be, that's called reasonable confidence and high return portfolio. And that today is around 13 odd percent, 13, 14% as such. So that's why it's, we would be rather, looking at that portion of the portfolio quite keenly as such. So leave it there.
Okay, fair enough. And, are you still believing, Dinshaw, that, pharma continues to remain a safe haven? Because if the portfolio strategy is that high valuations are acceptable up to a point when it comes to high quality companies, which ones within the pharma basket would, fit this criteria?
So, Aman, the point is that pharma remains a fairly insulated part of the industry. In the markets today. But you have to be careful there. You've got to be very clear that those exposed to the US are going to suffer because already, you were seeing that the pricing pressure in the US is not coming off. In fact, every quarter, the reports that come out show you around 8-9% degrowth in pricing. So you've got to be clear about their pipeline. That's one thing that you've got to keep in mind when you're identifying stocks which are US exposed. Secondly, the domestic exposure plays are the ones where you really need to keep an eye out. I think that's where probably the valuations are a bit stretched, but the fact is there's some kind of upside left there as such. So that's another one. And then the API plays. This is the one where the PLI schemes will be kicking in a way. So if that happens, these are the ones looking good. So those are the stocks that you need to keep in mind. But once again, be very careful in that names because certain names have, though they are identified as API plays, but they are concentrated into one particular segment quite heavily, and that has helped them in improving their performances. So if that comes off, which was COVID related, that should have an impact in the future earnings. In fact, some of the big names you'll see a degrowth in earnings going forward. So you have to be careful there. So that's how we should be playing the pharma sector.
Speaking of names that have suffered due to the pandemic or have been impacted due to the same, that's a space as well that you believe, has some long-term potential?
Yes, definitely. In fact, you can call it opening trades, if you will, but there's quite a few openings which have happened in the past, and still there's a lot of upside left. So some stocks in the hotel sector, which not the top tier hotels, but the second rung hotels where the competition was actually the local hotels, which have died down in this pandemic. I mean, in fact, quite a few 3-star, 4-star hotels have shut because of this. So those are the names you want to look at in the hotel sector. Then you're talking about certain plays which is very different from what you may see in the market, which is related to your wedding sector as such. I mean, there's one name which is into the wedding wear and stuff like that. I think that looks very exciting. In fact, we bought it not only in the IPO, but we increased our exposure also as the stock corrected going forward. So, and fortunately for us, finally the market caught on to the story and it's done fairly well. So these are the kind of different plays that you want to play up in the opening trades as such, and not the regular ones that you see.
If it's the same name that Nikunj and I are thinking, we're wondering if it's a very small holding or a big one.
No, it's a fairly, not a big one, but it's a fairly decent holding in our portfolio as such. So, I'm sure you will have guessed the name.
Not unfortunately.
I can.
I cannot.
Okay.
Manyavar.
Manyavar, is it?
Yep. Yeah, she's right.
But Manyavar is into kurta pajama. That's the main business. Where did you women's wear?
No, and women wear. Alia
Look
Bhatt
at percentage.
Their,
look at percentage
brand
of total
ambassador.
sales. Look at percentage of total sales. Dinshaw, am I getting it wrong?
But Dinshaw, since you must be speaking with the management, please ask this one question: that all the, everyone from Anushka Sharma to Alia Bhatt are their brand ambassadors, but they end up wearing Sabyasachi for their own weddings.
Yeah, that's the story there, Aisha. Actually, it's not a super luxury brand. It's a affordable luxury brand, and that's where the things work out. Actually, Nikunj, just to add to your this thing, there's no percentage which is wedding driven, but the fact is that whenever you wear a fancy kurta, you normally go to a wedding for that. I mean, I don't remember going for a dinner with a fancy kurta as such. So that's why I classify more as a play on opening trade. And frankly, I mean, it's like a McDonald's model, if you will. They had the store, flagship stores of Manyavar, and they've gone about adding brands to those stores, which are appealing to, say, women, to appealing for, festival wear and stuff like that. So it's like a McDonald's adding your, breakfast cereals to with their whole offering, or a drive-in, or a cafe and stuff like that. So I think that's, and it's on the way up. It's on the way up, right? So I won't discuss much further, but we have a long-term view on this stock, and I think it's going to do fairly well.
Especially given that market is just so unorganized, besides these high-end designers, it's got a long way to go.
Right.
Okay, let's just take stock of where the market also has settled in at. Not bad actually, 17,100 is what we are holding at currently. So Dinshaw, you've talked about, the spaces where you're long and the spaces where you're short. But I want to talk about two sectors which are sort of at the, center point, if you will, or at the core of the market direction from here. IT on one hand and banks on the other.
Okay. So IT, Aisha, the fact is that we see top line is not a problem at all. In fact, we were one of the big bulls in IT not so long back. In fact, we've been that's probably a concentrated holding was there from the beginning itself of not only our present offering in the domestic market, but also in our offshore fund, which has been around for a while now. So, but the fact is that top line is not going to be an issue going forward. In fact, if you see the numbers which were reported by most of the guys, the top line wasn't the issue. The issue was not the bottom line, but the margins. Now, we believe that margins going forward, in fact, our view was that, the supply chain issues, I'm talking about the supply issues in terms of manpower will even out in the next couple of quarters. Doesn't look like it. So one has to keep a very close eye on the attrition rates, which are very sticky, which we thought will come out, but they've been remaining at those levels for a while now. So one has to be very careful there. And the fact is that even with the global markets opening up, the SG&A expenses are going to move up, traveling costs are going to move up. Obviously, clients are going to look at more on-site presence as such. So that is not working in favor of margins today. So that's why we're being cautious here. Otherwise, as I said, top line is not going to be an issue. But the fact is that let's give it a few quarters and see how they manage that. It's a transition period for the industry, right? So one has to see how they are able to manage. And that's why even today, the exposure that we have is in only tier 1 IT. In fact, any tier 2 which we have, we sold off as such because we believe the tier 1 is the best place to manage this kind of transition going forward. On the banking side, we remain fairly bullish. In fact, the results that came out, you saw ICICI Bank results, they were fairly good results. They were, in fact, excellent results, to put it mildly. But the fact is that this sector, in a rising interest rate scenario, in fact, the private banking sector per se is a big beneficiary, right? Let's not go into why, but the reason is obviously the NIMs have to move up, given that most of their lending is in floating rates and their borrowing is more or less CASA or certain deposits which correct over a period of time as such. So that's why the NIMs will move up, and that's why we're so bullish. And the fact is that if the economy is opening up, that's where the real growth, demand growth for the loans and all credit will come in as such. So that's a sector that we are very keenly watching. In fact, we've got massive overweight in that sector.
Dinshaw, are the concerns around HDFC Bank merger justified? You had a long association with HDFC Bank. Are markets getting too worried about this transition because the stock has fallen flat? It has fallen flat post the merger announcement.
Right. So Nikunj, I think it's overdone, frankly. I mean, we are fairly covered. The fact is that with the merger of the two banks, the HDFC Bank and HDFC Main, I think it's a very exciting proposition that's in front of you. The fact is that probably it'll be the 6th or 7th largest bank in the world after this merger. And obviously, I'm talking about market cap, right? So any global financial investor, I don't think he'll be able to avoid this kind of behemoth lying in front of him. I mean, if he's looking at global banks, obviously this will be one of the names will crop up as such. Agreed that the combined weight will be 14. And I think that's what is creating a problem right now, because most of the FIs have taken a very proactive call that we need to be we don't want that huge weight lying in our portfolio of the two merged entities as such. And maybe that's what is playing a problem here. But in the longer run, it's a win-win for both. In fact, a bigger win for HDFC Bank, which is going to be the listed entity as such. So,
around return ratios getting diluted, and the return ratios for the bank shareholders will get diluted more, and for HDFC Limited they would actually benefit. How valid are those concerns?
Yeah, that's going to be there in the short run, Nikunj, right? I mean, that's why we actually, if you see the ratio also which has been announced, it's today, if you look at the pricing of the two, it's more in favor of HDFC than in favor of bank. So ideally, any investor would be better placed to shift his holding on bank to HDFC and then play it out there. Though the merger, the actual merger will be after 12 to 18 months, but that's still a good play going forward. And going forward, obviously things will even out. Initially, there will be some hiccups, but I don't see that being a problem going forward as such.
So, Dinshaw, we've had a volatile year so far. 2022 has been marked with volatility, a lot of macro news on the war front, and a big energy shock. For the second half of this year, let's say from May to December or from June to December, what is in store?
So, Nikunj, actually, we were expecting that the markets will correct a bit. We were looking at, and that's why we were cautious in the beginning. And in fact, we thought that probably the next few quarters, but I think it's getting stretched. I think the Indian investors are very stoic, very resilient, and to such shocks. So maybe you may see a time correction going forward. I don't know if there's a big correction coming in or no. I mean, as in even a high single digit correction in the pipeline. But the fact is that it's held on and maybe it will hold on. But the fact is that even if we go wrong, I don't see the markets running away. There's no way you can see the markets giving you massive returns from here on as such. It has to either time correct or it has to give you some correction before the move comes in. But that doesn't stop you from identifying stocks. As I just mentioned a few names to you, these are the names that in fact, the cash that we raised at one point in time was 25%. But the moment we realized that, okay, things are not working the way we thought it would be, we started investing slowly into select names. ITC was one which you mentioned. So was Vedant Fashions, which was the name that we picked up. So we've been doing that, picking and one hotel stock we picked up and one beverage company we picked up. So we've been doing these kind of picks, and frankly, I mean, they worked perfectly well for us. So you'll have ideas coming up at any given point in time. I think that's where you need to be. You can't be out of the market fully, and that I think answers to an extent your question also, why only 10% cash and why not more. I think we did that, but we changed. That's what I think sets us apart. We're very flexible in our view in the market. We're not, because for us, as I told you, a long term is a series of short terms, and we keep analyzing on a shorter term basis to see what the long term is looking like.
Dinshaw, it's been a pleasure interacting with you. Many thanks for joining in and giving us an overview as to what the outlook is on individual sectors as well as the overall market stance.